Inflation fell again last month more than expected, which means we're probably going to see that money printer fire up again soon. You can see this chart of the CPI shows April year-over-year inflation fell to 2.3%. That means prices in April 2025 were 2.3% higher than they were April of 2024. Now this was a drop from a month earlier in March where the CPI was at 2.4%. Now you can see even though it's been volatile for the last couple of years, the CPI has been moving lower. Now some economists were astonished by this because they expected that the tariffs would be pushing the CPI up higher. That is not how tariffs work. When you artificially make some things more expensive with a tax, it just means that people have less money overall to spend everywhere else, which means tariffs slow down the economy. Without a broad-based increase in the overall money supply, you would not be getting a spike in prices. I don't know why this is such a hard concept for mainstream economists to grasp. So why am I saying that this is likely to allow the money printer to fire up again soon? Well, it's because the Federal Reserve, by law, is mandated to care about three things: employment, prices, and interest rates. Now, the thing that makes their job difficult is that they only have one tool to manage all three of these, and that is either money printing or money destruction, injecting liquidity or withdrawing liquidity. When they're printing money, it will help unemployment, but it will hurt prices. When they're destroying money or withdrawing liquidity, it will help prices, but it will hurt employment. And so the fact that inflation is continuing to fall means that they don't have to worry about the negative effects of money printing pushing up prices. And in the face of a softening labor market with rising initial jobless claims, they will have more freedom to lower interest rates and quantitative tightening, or maybe even resume QE again. Now, I mentioned before that they also care about interest rates, and this is the little known third mandate given to them by Congress, which is that their job is to moderate long-term interest rates. Now, whether that means 10-year treasuries, 20-year treasuries, or 30-year treasuries, that is left up to interpretation. And whether that means 3%, 5%, 10%, or somewhere in between, that is also left up to interpretation. But it is a fact that it is their job to maintain moderate long-term interest rates, and that job has been given to them by Congress the same way that they are told that they have to care about maximum employment and stable prices. Now, earlier I talked about how unemployment and inflation moved opposite to each other when the Fed decides to print money or withdraw money from the system. So how does that impact interest rates? Well, it actually depends on where we are in the long-term US debt cycle. The last time the US government was in a deleveraging phase was from 1940 through 1980. During this time, you can see interest rates rose significantly. During this same time period, the United States government's debt compared to the size of the GDP dropped from about 120% down to about 30%. During this time, the Federal Reserve engaged in yield curve control and other tools to help the US government deleverage. This caused higher inflation, higher interest rates for the average person, but it allowed the government to perform an inflationary deleveraging. Now, the pendulum swung back the opposite direction from around 1980 until 2020, with interest rates dropping over time, allowing the government to re-lever up. You can see during that time, US debt to GDP rose from about 30% all the way back up to 120%. Now we have entered the deleveraging phase of the US debt cycle yet again, with interest rates rising, inflation rising, and the government's debt to GDP ratio starting to fall. This will be another inflationary deleveraging, where the US government gets to borrow at rates lower than the rate of inflation, helped by the Federal Reserve. This causes inflation for all of us, which pushes interest rates up for all of us. Even though there are certain periods of time you can see where interest rates do fall, the overall trend is higher. And the same will be true here. Since everything bottomed in 2020, we have and we will continue to see short-term periods of time where rates will fall. The long-term trend here is an inflationary deleveraging for the US government. So if and when interest rates do dip a little bit, those are times to take advantage. Lock in low rate debt for as long as you can. Aggressively buy assets that will be lifted from all of this money printing, from this inflationary deleveraging. But understand that for many, many years, potentially decades, we will not see the same type of environment that many of us are familiar with. In other words, this 40-year time period of falling interest rates and falling inflation is done. It's history. That 40-year bond bull market is over. We are in a bond bear market now. And increasingly, the biggest buyer will be central banks like the Fed. Like I said, this is going to be very beneficial for asset prices, which is one of the reasons why we've already seen a new bull market emerge from the bottom of the bear market as investors start to price in that new future reality. Now, if you'd like me to help you apply ideas like this to your own investing so that you can grow your portfolio and protect it during times of crisis, click on the link in the description below. As always, thanks so much for watching. Have a great day.